Hey there, yesterday I received an email from Interactive Brokers saying that it was my 1 year anniversary since registering with this broker. So 1 year ago, I set up an account and had zero balance in it. And after 1 year, I have almost 140,000 US dollars investing portfolio. And in this video, I want to tell you what was my strategy, where I was investing into, and what will be my strategy for the next upcoming years. So watch this video until the end so you can see the entire details of my portfolio and you can copy it. So now on the screen, you see the total value of my investing portfolio, which is 138,000 as of today. And this chart represents the value of my portfolio over the last year since I started my Interactive Brokers account. So I want to tell you the several concepts I've been utilizing while creating this portfolio. So first is not to have the single entry price, not to take all of my money and invest into what I want today. So the concept was splitting my money into equal parts and then define the period of time over which I want to enter the position, and then consistently with these equal parts every month investing into my portfolio. And the idea why you split all your money into equal parts and invest over a period of time with these equal parts every month, so consistently over a period of time, is because you don't want to have a single point of entry into your position. Let's say the price of a share is $100. If you invested everything into these shares just today, you have the entry price of $100. And if the price goes down, you're losing money. Your unrealized P&L is in loss. Comparing to if today the price is 100 and you invest in just 10% of your money, and tomorrow the price is 90, you can invest another 10% of your money, but this makes your average entry price lower than 100. So it makes you to avoid a situation when you will invest all your money into the security on its peak price. For example, in 2021, it was a very good year, and all the indexes, basically everything, both crypto and stocks, they had the highs, right? And everyone who invested, who put all their money into the crypto or equities in 2021, now they still suffer losses, and pretty significant losses, to be honest. For crypto, it's 50%. For stocks, for some stocks, it's also 50% or even more. For Netflix, for a lot of technology stocks. So to avoid this, it's better for you if you had invested into stocks in 2021, like 10% of your money 1 month, then 10% another month, and while the market has been declining, right? You've been entering into position, making your average entry price lower and lower. It makes you to have just a better entry price. This is the reason behind the concept of splitting the money you have and investing over a period of time. Also, it's important to realize that your strategy can be different from if you have the monthly income from your salary or whatever other income you have, you can take the share of that income, the percentage, and invest it into your portfolio with the same idea. Once you receive your salary in the end of a month, you take, I don't know, 10, 15, 20% of it and invest into portfolio. Another concept is to take as low risk as possible. So for this, I was using ETFs mostly, which is exchange traded funds, and you can check the separate video about ETFs on my channel. So basically, exchange traded funds help you to diversify your investment from betting on a single company or single country to betting on the entire industry or idea or even region. So my general idea was to invest into ETFs. Also, later I added the strategy of investing into several individual stocks. This is basically the companies I trust in and I'd like to have in my portfolio. But the share for that individual shares investment is very low. It's lower than 10% of the entire portfolio. And later also, as you can check my latest video about how I'm investing into US bonds. Later, I also added the debt securities, basically bonds, and one debt ETF, TLT, just because the Federal Reserve was increasing rates, and it is very was hard to resist not investing into debt with such a high interest rates, to be honest. So on a screen you can see the list of the investments I made. And here we can go one by one. And I will start with the largest investment which I made, which is VTI. VTI is Vanguard Total Stock Market ETF. This is basically the fund which invests into over than 5,000 US companies. So this is basically represents the entire stock market of the United States. And if this single company goes bankrupt or suffer any kind of difficulties or headwinds, it doesn't affect the entire ETF stock price significantly, just because they have 5,000 companies in its portfolio. And as you can see, the current unrealized P&L is $1,400. I invested $45,800 into this ETF, which is basically like 33% of my entire portfolio is VTI. And here you can see the history of my investments. And as I told you that not all investments are shown here, but you can see the idea that in the beginning of each month, like December the 8th, 2022, invested $3,000. Then January 2023, I invested $3,000. Then February, I increased the amount I was investing to $5,000. Then March, April, May, June, July, August, September, October. So basically every month I invested into VTI. And just to give you a brief idea for those who don't know this ETF very well, you can see that the fees which this exchange traded fund charges, the fees are pretty low. The total expense ratio is just 3 basis points. And the total net assets of this ETF is almost 300 billion US dollars. So I saw the stats of top 10 ETFs by fund inflows into ETFs in 2023. And as you can see that VTI is a number 4 ETF for total inflows this year. The number 1 is Vanguard S&P 500. This is the ETF which just tracks S&P 500. And the same ETF for BlackRock or iShares, number 2. Number 3 is TLT. This is ETF for the bonds market, the debt. And number 4 is VTI, the one I have in my portfolio for like 33% of its value. And we can go one by one, look at all other investments I have. So I have investment into Tesla. This is just an individual stock investment I made. The amount is not huge, just for 2005, the total investment. The next one is TLT. In my latest video, I've been showing you guys how I invested into TLT. You can see that the cost basis is a little bit more than 6,000 US dollars. And as I told in that video, that I think this is the pretty bottom for this security, and my plan is to see the rebounds, the upside during the next year. The next one is SLYV. This is the ETF which tracks small cap companies. And obviously sometimes when the companies are overpriced, like the biggest companies in the world, which are included in the S&P 500 index, sometimes when the economy is overheated, everyone realizes that this is too much. This company is just overpriced. The price to earnings ratios is too high. And the market starts to discount these companies. At these times, usually smaller companies, they see the increase of inflows, the prices could be steadily grow. That's why I have an ETF which deliberately invests into small companies. The next one is QQQ. This is a very famous ETF which basically tracks Nasdaq, and it has one of the best returns in my portfolio. You can see that I started to invest into it not so far away, just in April, and I basically regret that I didn't start to do it earlier. The next one is Nike. This is individual stock. Investment not so big, 2.5 thousand. The next one is cars. This is ETF for alternative energy. I was looking for ETF which invests into entire electric cars industry. To be honest, this ETF performs not so well, and I even consider exiting it. You can see that current total negative return is minus almost 19% just for 1 year. This is pretty much. And even more on top of that, if I look at the expense ratio is 0.72, which is also not so low. The next one is IUKP. This is the ETF which tracks UK property. And I basically also regret entering this ETF last year, just because I entered it in April 2023. But my idea was I truly trust in the long-term perspective for property, especially in the developed countries like the United Kingdom. But as the interest rates are growing up now, the current trend for all the property is bearish, right? It goes down. But nevertheless, property during long term, especially until 2045, will grow. So I expect this to rebound. The current total return for this is minus 7%. The next ETF is IEMG, which is the ETF which invests into emerging countries. And I have a separate video about which ETF to invest in, and you can see I'm explaining there about the strategy behind investing into emerging markets. And you can see that it didn't perform very well. It's like minus 1.7%, basically due to Chinese struggles. And currently, Chinese economy it slowed a lot, and China is a part of emerging markets. So if we see the holdings of this ETF, we can see that China is number one here. Like 24% of all holdings for this ETF are Chinese equities, and Chinese equities has been declining during the last year. Okay, and the next one is IEFA. This is iShares BlackRock ETF. So its strategy basically to invest into Europe, Australia, and Far East. So it's non-US investment. And when I started to invest into VTI, which is only US companies, I realized that I have big exposure to the United States economy in general. And even though I don't believe that US economy will be very weak in 20 to 30 years period, as I told you, I want to have the lower risk. So I want to hedge against any huge problems which could be just for United States. Rational thinking, I understand that if United States, if they have some problems, the entire world is going to suffer a lot. But anyway, I want to diversify my portfolio from investing just into United States to investing into something outside of United States. This was the idea behind investing into ETF I just showed you. FXI is ETF for Chinese market, and it didn't perform well. As I told you, China is on a decline now, but as of today, it's minus 13%. It's also important to understand that these 1 year returns, they at least not final, right? Because this is a long-term portfolio, and this is okay if UK property is down 5 to 10%, you know, a year. In a long run, in a 10 years period, it will go up anyway. Because if you annualize the returns of equity investments in general during the last 100 years, they give about 8 to 10%, stocks a year. But obviously there are years when there are minus 40%, and there are years when it's plus 20, plus 30 every year, several years in a row. So this is EWS, this is EWC, the ETF for Canada. So they purely invest into equities of Canada. The EWA ETF, similar to Canada but Australia. EPI is ETF which invests into Indian equities, and to be honest, as you can see, it has a return of 16%, which is pretty good. I'm a big believer into in Indian economy in the next 10 years. That's why, and in general, I believe in emerging markets economy, which is Brazil, India, China, Turkey, Argentina, and other countries. Because I see the potential for them to grow. The developed countries, they already have very overpriced valuations of the companies, and there should be the limit, for the growth. And obviously they will not grow like 20-30% a year. They unlikely to be a very fast growing economies just because they're already developed, right? So emerging markets, they just have the potential to grow fast. And India, I truly believe, is one of the main drivers of emerging markets growth. So I have a separate ETF for just India. EMXC, this is ETF for emerging markets except China. Once Chinese economy started to slow down, and you probably heard that Vanguard, which is a very big asset management company, along with BlackRock or Invesco, Vanguard completely exits China. And Chinese tensions around Taiwan and in general with the United States or global West are being intensified. So a lot of manufacturers, they move the productions from China to Southeast Asia or even India. That's why I invested into ETF, which invests into emerging markets equities except China. This ETF, EIMI, is also about emerging markets. This is ARK Innovation ETF, which is headed by Katie Wood, and they just invest into disruptive, innovative companies, and they've been doing pretty good. So they pick up very innovative companies, and you can see that they have a positive return of 4%. Obviously Apple, this is individual stock. This is the US government bonds. Another one. Yeah, and this is the end. So this is all the holdings I have with my comments on that. As you can see, here's the cost basis. If you want to dive deeper, you can stop the video and see how much I invested into each of these securities. This is my current unrealized P&L for each of that. So I hope you enjoyed watching this video. You can actually copy this portfolio if you agree with ideas I have, and let's see how it will perform in the next run. Thanks for watching, and please subscribe to my channel not to miss the next videos I'm gonna make.